name is Blake, and I'm with Kachuwa Impact Fund. And just a brief intro to Kachuwa. It's an investment cooperative, which is, there aren't that many in existence, but it's using the cooperative structure and applying it to a more conventional investment fund structure and kind of, seeing how those two overlap. And many of you may be familiar with cooperatives, but one of the hallmarks of a cooperative structure is that it's one member, one vote. So in this case, no matter how much money you invest into Kachuwa Impact Fund, you only have one vote, just like everyone else, as opposed to, in a conventional fund, it might be in proportion to how much you invest, or that's the way it would be if you own stock in a company or something like that. There are a few other cooperative attributes to it, but that's the big one. So it's an investment cooperative. And then it's what's called an open-ended or evergreen fund. Most investment funds have a beginning and an end, and you invest money, and then the fund managers invest the fund money over the course of a certain period of time. And then what they try to do is they try to reach an exit for everything they invest in and turn it back into cash and provide you your money back plus a return on investment within a certain period of time, say 10 years. And that would be like a closed-ended fund. But Kachuwa Impact Fund is an open-ended evergreen fund. So the portfolio, we don't try to liquidate it or find an exit or provide a return in a certain timeline. The portfolio is intended to kind of exist in perpetuity. There might be changes to it over time, but if someone joins the cooperative in 2022, they'll be investing in the same portfolio as someone who invested in 2019, and as someone who invests in 2030, they'll be investing in the exact same then current portfolio. So that's what that means. And right now it's about 30 million in assets. It's growing pretty quickly, and 30 million is maybe what would be considered a small fund size, but also big enough to have enough critical mass. And we're growing it each year. And the larger it gets, that's great, because it means the more diversified we can be, the more impact we can have. And the more diversified it is, the better for all the members, and the more impact it has. That's part of our mission, is try to have impact. And I'll talk some more about that next. The cooperative is engaged in two primary activities. The first one is owning and operating impact real estate, and we'll talk about how we define that later. And then kind of a secondary activity is investing in privately held impact companies. And by privately held, we mean that it's not publicly traded on a stock exchange. So not on NASDAQ or New York Stock Exchange, they're privately held. And as Janine mentioned earlier, we aim for about a 60-40 split. So 60% or more in impact real estate, and 40% of our portfolio or less in impact companies. So one way I like to think of it is that Kachuwa Impact Fund is kind of similar to a mutual fund combined with a real estate investment trust, but it's on Main Street and not on Wall Street, and it's exclusively focused on impact. And its main goal is not to maximize profit for the stockholders or the members of the cooperative. Our goal is to make a reasonable return, but not an extractive return, make a reasonable return while also maximizing our impact. So we're what's called an impact first fund, as opposed to a financial return first fund. Some impact themes that the cooperative has. These can change over time, but right now these are the 10 that we each investment that we make, whether it's real estate or an impact company investment, has to align with at least one of these themes. But usually we look for what I call a double word score or a triple word score, where it might be an employee-owned company that's got female management and it's in renewable energy. That would be a triple word score, and that's what we look for each time. So impact companies, I'll start by defining this before I define impact real estate, because I think it can help. But an impact company, we define it as a company that has a positive impact on society and environment via one of these. So it could be what they do. It could be that they produce organic food products. It could be that they install solar systems. It could be that they, what's another good example? Anything that they do and what they produce, that could be what their positive impact is. It could be how they operate. They might be a cooperative democratically owned and controlled by members. It could be employee owned. It could be a democratic workplace. They could have rules on, their board of directors must be at least 50% women or BIPOC, things like that. Who they benefit, that could be the ownership group. So the owners could be predominantly BIPOC or women, or it could be employees. It also could be benefiting the customers. So who are their customers? Are they a lender that provides loans mostly to low-income borrowers? That would be another example. And then where they operate, the company could operate in an economically disadvantaged area, or it could be in a rural area where people are moving away from, and they're trying to kind of help develop the economy in a rural area. So we look at any of those examples in determining what is an impact company. And in a similar way, we define impact real estate as having a positive impact on society and environment through how the real estate is used. So it could be farmland, but they're converting it to organic farmland, and it's only intended to grow organic produce. It could be a building that's used as a homeless shelter, or that a nonprofit or an impact company, how we defined it earlier, an impact company uses it as their office space. The next one, how it's designed, built, or renovated. So it could be a very environmentally friendly building, very energy efficient with it's solar powered. It could be LEED certified. I don't know if anybody's familiar with LEED, but it's a certification for buildings. So that would be an example of that. And who it benefits and where it's located, very similar to what I mentioned with impact companies. The impact real estate that we do, we always try to share ownership with the tenant that occupies the building. We don't just want to replicate a traditional landlord-tenant relationship. We want the tenant to have some ownership in the building, and that helps to make it more impactful for us if the nonprofit that is renting the building is also getting some ownership in the building over time. And then where it's located, it could be an opportunity zone, it could be in a blighted neighborhood, it could be and I think I have a good example of one with an interesting location later, but that's how we define impact real estate. So what we do with impact real estate, or how the kinds of impact we want to have, is we want to help our tenant partners, those who are occupying the buildings. And so far we have only had commercial buildings. So we haven't yet had, residential or apartment buildings or multifamily buildings. It's all been commercial. Well, first and foremost, we want to help the tenant gain control of their real estate destiny. A lot of times, companies and nonprofits, their rent goes up dramatically, and as real estate prices go up, their rent might go up so quickly that it pushes them out of the neighborhood that they want to be in, or the community that they want to be in. Sometimes too, a building might be sold out from underneath them, and then they're forced to move because they're going to sell it to someone who's going to develop it into condos, condominiums, or something like that. So helping them gain control of their real estate destiny so that they're not worried or insecure about what's going to happen in the future, or can they stay in a certain place for very long. And I'll give some good examples of tenant partners that we've helped in that regard. We want to provide long-term rent stability so that even if the market is going up at 10% per year, our goal is not to increase rent on them as quickly, because we want them to be able to stay there long-term. Or we might be willing to sign a very long-term friendly lease with them so that they know they can stay there for a long time. As I mentioned earlier, we want to share ownership with them. So we will offer them a minority ownership in the building, say 30, 35% ownership in the building, after our cooperative achieves a certain financial return. And the tenant can earn that ownership in the building by helping us to manage the building. They're occupying it day in and day out. They can help self-perform property management. They're the first line of defense for maintenance. Usually our tenant partners enjoy doing that because they save money by not having a third-party property management firm do all of that. And then usually a landlord will just pass through those charges to the tenants. So they can save money by doing that, but then also them helping us to take care of the property and to manage it and to keep the books and to file tax returns for the entity that owns the building. That's what we say they're using sweat equity to get some ownership in that building over time. Most of our tenant partners are able to do these projects with us without putting in any capital. Like they might not have any money, or all the money they have they're using towards their operating their company or their nonprofit, or we want them to use that money towards fulfilling their mission. So we're happy to buy a building and provide all the capital on their behalf, but still share ownership with them. And then we don't provide any pressure to sell the building. So if they want to occupy this building and co-own it with us for 20 years, that would be great from our perspective. We don't need to sell it within 10 years so that we can provide returns to our stockholders. We're not a conventional fund in that way. And all the members of our cooperative are what we call patient investors, knowing that they're making investments over the long term, and we don't want to pressure them to sell the building or to move out or anything like that. And then this last bullet point where I say provide a good plan B, whenever we talk with a prospective tenant partner, we always encourage them to pursue plan A, which is if they can buy the building on their own, we think that's in their best interest. If they can find the capital, if they can get a mortgage, and by the capital, I mean, they need to come up with a certain amount for a down payment. The same way when you buy a house, you might need to put down 20% and then you can get the other 80% in a mortgage. It's something similar with a commercial building. If they're able to do that without and not hamper their ability to pursue their mission, we encourage them to do that as plan A. And if some of our tenant partners, after exhausting all the possibilities for trying to make plan A work, we'd like to say, hey, we're a really good plan B, because we do think it's in their best interest to try to buy and own that building themselves if they can, and if they've got the wherewithal and the resources to do so. Deal flow, how do we find projects? It usually comes from our network, so members of the cooperative, in companies, impact companies that we've already invested in, and other partners. And usually what they'll do is they'll have conversations with a nonprofit or an impact company somewhere, and they might be telling about how they're having trouble with their building or finding a home, and then someone recommends that they talk to us. And almost all of our projects start with an impact company or a nonprofit coming to us in need, saying, we've identified the building that we want, it's for sale, we can't afford it, or we don't have enough capital, can you help us to buy this building? This building is perfect for us. Or our home of 10 years, the owner has put it up for sale and we're worried it's going to be sold out from underneath us and we might have to move out soon. Can you help us be the ones to buy it? So that's how the projects come our way. We aren't like some real estate investment companies. They will go and buy a building, or they'll develop it. They'll build a new building and then they'll go and look for a tenant. We do it the other way around. It always starts with a tenant who has need for gaining control of their real estate destiny, and then we help them to buy the building. So some of the variables, some of the project variables, and there's a lot of them, but I've got a few examples here. When we're talking with a tenant partner to see if we can make this work, is base rent. How much rent are they able to afford? Oftentimes tenants come to us saying, we really need to keep rent low. And if we can keep it low for a longer period of time, that provides us some more stability. Or we're a fast growing startup and we need cash to reinvest in our company now. So if we can keep rent low in the first 5 years, we're okay with having it catch back up to the market rent, after that. But base rent's a big variable. The shared ownership split, we need to, the cooperative, Kachuwa, needs to be a majority owner of the real estate in order for it to count towards our 60% allocation in our portfolio. But that just means it needs to be 51%. So when we talk about sharing ownership with the tenant partner, that could be anywhere between 1% to 49%. And that's a big variable. What's most important to the tenant? Is it having low rent, or is it maximizing their long-term ownership potential? That's something we ask them about, and we can change those variables based on what they want. The third one is what I'll call a hurdle rate, or it's the return on investment that Kachuwa needs to satisfy before it triggers the flip in the ownership. So if we provide all the capital for a project, Kachuwa might own it 100% on day one. But then after Kachuwa achieves a 7% return, then the ownership flips from 100-0 to 60-40. And then the tenant partner has 40% ownership after Kachuwa has achieved its 7% return. because for us, 7% is an example, might be, that's a reasonable return. We don't need double-digit returns like a lot of conventional real estate investors. And once we've done that, we really want to share all the upside above and beyond that. The ability to obtain a mortgage and at what terms, that's very important, because we can bring a lot of financial strength to the table because our cooperative has 30 million in assets, it's profitable, it's doing well. But when we go to apply for a mortgage to buy a building, the mortgage lender will look, who is the tenant, who's the primary tenant, and how creditworthy are they? Are they going to, is it look confident that they're going to be able to pay rent every month? And we help out a lot of startups. And sometimes those startups are difficult for the mortgage lender to get comfortable with. And then as a result, we may not be able to get a mortgage, and Kachuwa might have to put up 100% of the capital as equity in order to buy the building. We're willing to do that. We've done that before, but that's one of the variables. Another variable is the risk and the impact. So we don't mind taking high risks, but if we're going to take a high risk, usually what a conventional investor would do is if they're taking high risk, they would want a high financial return. And risk and reward need to be in balance with each other, is what a conventional investor might say. We're okay with taking high risk. We don't necessarily want to take an extractive return or a really high return, but we might want to see a very high impact in exchange for taking that high risk. So we take a look at how much impact is there. Is it a double word score, a triple word score? Are we having a positive impact in multiple ways? And that can help us to get comfortable potentially with taking a little bit higher risk than normal. Next, the tenant's financial health and their ability to help co-manage the building. So like I mentioned earlier, there might be a startup. They might not have been profitable consistently, maybe only every other year or something like that. That's just something we want to take into account. It kind of overlaps with some of the other bullet points I talked about. A renovation budget. Sometimes a tenant partner will identify a building and say, that's the perfect building for us, but we need to put in $1 million of renovation in order to make it exactly the way we want it. We're fine with adding renovation budget, but we've even bought one building where we bought it and then we spent more on the renovation than we did on the actual purchase of the land and the existing building. And that can sometimes represent higher risk or a little bit more complexity. So that's another variable. Is the building good to go as is? Does it need a lot of renovation? Sometimes construction budgets, insert joke here, they often go over budget and longer than timeline. That's just something we want to take into account. And then this last bullet point is interesting because sometimes a tenant partner will identify a building they want, but they only need 60% of it. The other 40%, they have to go and find subtenants in order to make it work. And we usually like for them to manage the subtenants. That's one of the ways in which they earn sweat equity in the building. But how many subtenants, how much space are they going to have to manage? That's something we want to take into account because that is more complex and more difficult for the tenant partner to have to manage, 30,000 square feet and 15 subtenants. That's a lot of moving parts, but that's something we take into account when we look at a project. So those are some examples of variables that differ from project to project that we take into account when we design how it's all going to work and how we assign numbers to each of these things. So next, wanted to do some storytelling. Village Institute is a nonprofit in Denver, Colorado, that we just helped to purchase a building. They are relatively new. They've only been around for a couple of years. Started by a very gritty, persistent woman entrepreneur that we've been very impressed with, for her to basically start this from nothing and created this wonderful nonprofit that helps predominantly refugee, but also immigrant families, usually single mother refugee families. So single mother with kids coming to the United States, settling in Denver, but coming to a brand new country, not knowing where to go. This provides, they call it a live, learn, and work center, where the second floor of the building has a few apartments so that the mom and the children have a place to stay immediately. And they operate a daycare center out of the bottom floor. So the mom can automatically start helping to work, even if she doesn't speak good English, even if she doesn't have particular job skills for another type of job. She can help to take care of children in the daycare center on the bottom floor. So she instantly gets a job, and then they help her to learn language skills, other job skills, so that eventually they will transition the mother and her family to a more permanent place to live somewhere in the Denver community, and just help them to assimilate and to transition from whatever they were escaping to becoming a member of the Denver community. So wonderful impact. We love the nonprofit and what it's doing. And they found this perfect building that had the apartments on the top floor and had the daycare center classrooms on the bottom floor. And you can see there's a gazebo out there with a nice, yard for the kids to play in and to do things. It was a great property. But then the owner said, I would like to sell the building. And this is in a gentrifying neighborhood, and they were worried that somebody would come and buy the building and, kick out Village Institute and then redevelop it into something else. And then they would have to go and look for another property, but it's very, very unique property that perfectly suit their needs. So they approached us and said, can you help us? And we said, can you do plan A? And they tried to raise money from their donors and to get grants from foundations to try to purchase the building themselves. And they couldn't. So they said, we tried plan A, can you help us to purchase it? We tried to get a mortgage. We were unable to get a mortgage because it was a startup nonprofit that's very dependent on raising more money with grants. So we ended up doing an all cash purchase, $1.2 million last fall, to purchase the building for them. They've got a 10-year lease, and they're very happy. We're very happy. They were able to buy the building that they wanted. They gained control of their real estate destiny, and they've got good kind of visibility and certainty for being in the place where they want to be to grow their nonprofit and continue to pursue their mission. So that's one example. Here's another example of Southern Energy Management, based in North Carolina. This is an established solar company, certified B Corp, and the two owners, the primary owners, Bob and Maria Kingery there in the photo, they were looking for a larger space because they were growing, but they didn't just want to keep renting because they'd had some bad experiences with renting in the past. And so they said, we have a little bit of money, but it's not enough to buy the size of building that we need for our growing business. So Kachuwa put in 70% of the equity. They put in 30% of the equity. We co-purchased the building that they wanted. We were able to qualify for a good mortgage. And then in exchange for them managing the building, which they have a few subtenants that they need to manage, they can decide whether or not to renew the leases with the subtenants or to move into that space as it becomes open. That's completely up to them. And then once we achieve, I think it's a 7% IRR, a 7% return. So that's on our 70% and on their 30%. So when we both achieve the same hurdle rate, then it goes from 70-30 to, I think, 55-45. So they get additional equity ownership in the building once we both together achieve a certain rate of return. Upslope Brewing Company is a certified B Corp brewery in Colorado. And they, right after 2008, when they were growing really quickly, a business park came to them. So imagine a business park where it's predominantly offices and there's not a lot of amenities there. It's just mostly offices. This business park came to them and said, we have a great space for you. We'll give it to you for dirt cheap rent. We'll give you a huge renovation budget to make it the way that you want. And Upslope said, this sounds wonderful to us. So they signed a 7-year lease, had this wonderful tenant improvement budget, and they grew their business in that building. And because they were in an office park, it made the office park more valuable because now there's a place for people to go for happy hour after work. The office park loved it. And the owners of that building, the property values went up really high, partly because of the brewery being in the middle of the office park and made the office park more popular. Then when it came time to renew the lease, the landlord said, well, the property values have gone up and we're going to increase rent 40% if you want to renew. And Upslope said, oh crap, we can't afford that. But we've also put all of our brewing equipment here. We've sunk roots into this neighborhood. Like if we were to try to move, we'd have to drain all the brewing tanks, move them somewhere else, and then start fermenting beer. And there'll be a lag time. We might not be selling beer for 3 months while we do that. Like I don't know if we can actually move. So they needed help to buy the building, but the landlord didn't have it for sale, and they also didn't have any money because all of their money they were reinvesting in their business because they were growing so quickly. So they told the landlord, sell the building to us or we're going to move. And the landlord owned so many other offices in the area that they wanted to keep the brewery there to keep the value high for the other offices. And so they agreed to sell the building. And then Kachuwa came in and provided all the capital for them to be able to purchase it. And we said, all right, it's great that you're a local independently owned craft brewery, but we want you to become a certified B Corp. And we want to convert the building into a LEED certified building, because we need there to be more impact for this project in order for it to align with our goals. And they agreed to both of those things. So they made some changes to their business, became a certified B Corp. We've been working on LEED certification and we're almost there. We've been working on it for the last 2 years. Added a solar system to the roof, added electric vehicle charging stations, made the irrigation system more efficient, and a bunch of other changes like that. And now we co-own the building. They signed a 10-year lease. They're really excited to be in that building for the long term. And it's been a great success story. Namaste Solar, which is with another of my hats, I'm a co-owner of Namaste Solar. It's an employee-owned cooperative. When it needed a new building, similar kind of thing, it got pushed out of a gentrifying neighborhood in Denver. The rent became too expensive. They needed to move somewhere else. The only place that Namaste Solar found that it could afford was in the lowest income neighborhood in Denver. And there was a land trust, a nonprofit that was trying to buy up land there because they were worried about the neighborhood gentrifying. And they wanted to try to buy up some properties to prevent it from gentrifying in a negative way. And they were the ones who owned the building. And we thought, well, we want to become an anchor business in this area and be here for the long run. We're not looking to develop this and flip it. And they agreed to sell it to us so that then they could unlock the capital and go buy another parcel of land in the exact same neighborhood and try to prevent it from being gentrified. And so it's a similar story. We purchased the building, we converted it to LEED Silver, installed the solar system you can see there on the roof. And it's been a great fit for Namaste Solar. And we've been a wonderful, we've really enjoyed being in that neighborhood and kind of helping. There's a few housing develops, low-income housing developments nearby. We've done workforce training programs at those housing developments. So done a lot of neat things with impact, and another good success story in helping Namaste Solar gain control of its real estate destiny. This next one, Fork Food Lab, is one where we spent a lot of time on it, and we were really hoping that we could help out this nonprofit, but it didn't work out. And that happens sometimes, but I thought it could be interesting to tell a story of one that didn't work out. So this is a nonprofit shared kitchen. The nonprofit currently rents a building. They provide all the commercial kitchen facilities that one might want if you're a caterer, you have a small catering business, you work on your own, or you have a food truck and you need to prepare the food somewhere and then take the food truck out. So they're members of the nonprofit who want to use the commercial kitchen are a lot of very small food businesses, entrepreneurs. A lot of them are immigrants, and they don't have the ability to rent a commercial kitchen, much less occupy it full time. So they provide this shared kitchen space, and it was so popular that they ran out of shared kitchen space, but they wanted to support more small food entrepreneurs. This is in Portland, Maine, which everybody I talk to in Portland is very proud of how much of a foodie, and that's what they call it, a foodie city, where everybody just loves good and interesting food. So they found a building that they really wanted, that they were going to need to expand into. It would allow them a lot more room to grow, but it was going to cost a lot of money to purchase the building, and it cost a lot of money to renovate it. You know what? I think I have the wrong bullet points up on that. Yeah, I do. Sorry. So please ignore the 97 units of housing. But I forget how many small food entrepreneurs it was going to support. But in the end, we said, here's our model and here's how it works. Might this work for you? And Fork Food Lab wanted something a little bit different. They wanted us to be able to provide more money to the renovation up front before they had raised the grant capital to be able to do some of the things that they wanted. And to make a long story short, we weren't able to find a way to agree on the same structure and on when money would be available and how much risk there was in the whole project happening. So it turned out that they had some other options. We encouraged them to pursue those other options. Kachuwa wasn't the best fit for them because we couldn't provide them exactly with what they wanted, and that was okay. I haven't heard yet if they've been able to purchase that building, but we really hope that they are able to purchase it, because we loved what they were doing, and they have a really neat mission. And this is my last story, short stack, that it's two very impressive co-founders, female co-founders who have a lot of experience with affordable housing, and they want to develop multiple properties of affordable housing in the Portland area. And what we really like about this is, a lot of people use the term affordable housing, and we've been looking for ways to diversify our cooperative in, out of commercial real estate and also into residential real estate. If we were to do such a thing, we had always thought we would want it to be in affordable housing, but how do you define that? What's really neat about this project is that they're going to develop these projects where they're deed restricted. And that means that the deed of the real estate, kind of the DNA of the real estate, says that only people who have income that are less than 80% of the median family income can live there. And we think that that's a really neat way to kind of codify that we're going to build some fantastic affordable housing, but we want it to only be available to people who have lower incomes and need that affordable housing. So we're excited about this project. It's currently in what we call due diligence, which means we're doing research and we're kind of analyzing all of the project documents and the plan, and to see if it's a good fit for Kachuwa. We really like the two co-founders. We really like what they're doing, and we're excited about that one. So hopefully that's one that we'll end up investing in here soon. And my understanding is that Janine is also involved with them. So I don't know, Jean, anyone wanted to say anything else, but I think that was my last bit of storytelling.
Sure, so. I'll add something else. So I'm really excited that Kachuwa is looking at this. As some of you know, I mean, my goal is really to invest all of my capital in alignment with my values, and I mean all of it. And I am invested in real estate, and most of the real estate I own is traditional residential real estate in the San Francisco Bay Area, and I wanted to do something more innovative with it. I owned a piece of property with my sister. We sold it last year, and I was looking for something that could be impactful. And I met Anna and Jessie, who are the two women here, and learned about what they were doing in Portland, and ended up buying some property to support their effort. But what's really cool about this as well, Blake, is it hits your double, triple score too, because not only is it doing this great stuff around affordable housing and these properties, they're actually working on 3 different properties. They're going to have these 97 different units across 4 properties, actually. And each of the properties are in up and coming areas. So it's not like it's in some offside of Portland. It's like in some of the most trendy, desirable neighborhoods that they're going to be offering these alternatives. They are working almost exclusively with female teams. So they're architects, they're both architects, but they've hired an architectural firm to do the designs. Their architects are female, their construction crews are female. So they're going out and they're actually trying to make sure that the whole element of work that they're doing is really uplifting and promoting women in real estate, because there's so few women across every aspect of real estate industry. So that's very cool. And then they're also using some sort of wood, I forget what it's called, but they're doing renewable. So the build is going to be renewable. The kind of wood that they're using is a renewable. And so they're also trying to bring that environmental piece into what they're building as well. So it hits several of your goals, Blake. And I have just found them to be amazing, and they're educating me about real estate development, which is something that I've never known about before. So I meet with them every month, and they keep me informed on how things are progressing. It's been a fascinating and really wonderful partnership. So Blake, thank you. So I'm going to suggest that we stop. First, thank you very much for your presentation and your information. I found it fascinating, and I have some questions for you. So let's go ahead and stop the recording.